Welcome. In the next few minutes, in about 30 minutes or thereabouts, I'm going to teach you everything you need to know about how to start swing trading profitably, right? Now, it's not just the theory, but I will show you the actual mechanics, right? And also the psychology, right? And also the risk management that separates consistent traders from the 90% who actually lose their money to the market. Now, but let me be clear up front here. So swing trading is not day trading. They are different. You are not staring at probably the charts for 6 hours or thereabouts just to make a few moves, right? You are not holding positions through months and cycles of markets, right? So swing trading is that's very, very sweet spot in the middle, right? So you are basically um, catching the the moves between each swing points, right? That's basically what you are doing in swing trading. Now, so by the end of this video, you will basically understand how to find setups, when to enter, where to place your stop loss, where to take profits, and how to manage your risk. So that even when you are wrong, and you will be wrong in most times, right? But you will still survive to trade the very next time, right? So it will be a monologue for the next few minutes, as I've done before we get into the chart. I just want to flesh out a few things that we'll be doing, right? So grab a note and let's get on. So firstly, let's define this properly, right? So swing trading is a style of trading that attempts to capture short to medium term gains in a financial instrument. It could be stock, forex, indices, and whatever, crypto as well. So, and that is over a few days to maybe several weeks. Now, the core idea is very, very simple. We are just going to identify the direction of the trend. We will enter when the price swings back to a logical entry point within that same trend and exits when it reaches a logical target or when the trend reverses. It's just simple things. One, we will identify the trend. Two, we will look for an entry point. Three, we will find the best logical place to take profit. Simple. Now, uh, here's why I believe swing trading is the sweet spot for most people, including me. Right. So, first things first, time efficiency. Right. First things first. That is why I believe swing trading is the best option. Right. So, firstly, we will talk about the time. Right. So in swing trading, you will be analyzing markets probably maybe once a day. Right. You place your orders, set your stop and target, and you walk away. Simple. You really do not need to stop your 9 to 5 or whatever you are doing. Right. And you don't necessarily have to sit on your chair and watching the charts every minute of the day. Secondly, it reduces noise, right? The noise reduction on the charts. Noise reduction. Now, on a daily or 4 hour chart, no, actually, let me put it this way. On a 30 minutes, 1 hour chart, 15 minutes, right? You mostly see the random intraday noise there, right? And most times, this kind of noise, right, actually destroys your capital. Now, but in swing trading, we are not looking at minutes, we are looking at days to weeks. Right. Now, you basically see the forest, but not every leaf in the forest when you are doing swing trading. I like to use this analogy. But here's the critical distinction. Swing trading is not set it and forget it. No, it's not. You have to constantly check it as time goes by. So you actively manage your positions. You are watching for any change in trend, right? You are basically taking profits at some predetermined levels, right? So I would say it is actually active, but not really obsessive per se. Now, the typical holding period is probably from 2 days to around 6 days, or in fact, some week about 3 weeks or thereabout sometimes. Yeah. If a trade is going your way after about 5 days, that is a trading week, you might probably consider riding it out in most cases for me. Right now, what kind of instruments can we trade? Right. So instruments to trade, you can trade stocks. I do trade stocks. I'll start making videos for stock trading soon, hopefully. You can trade crypto, right? You can trade forex, and you can trade indices, right? You can probably even trade ETFs. I don't know. Well, I don't touch those things. Right. So you can basically trade any market using this kind of strategy I'm talking about here on this video. So next thing we are going to talk about here is before you place a single trade on any instrument, you must answer one expensive question. I call it an expensive question, right? You must ask yourself, what is the trend? Now, this is the Australian dollar trend. This is a forex pair. Now, overall, what is this trend saying? Okay. Let me switch to the weekly time frame. This pair is bullish, right? It's bullish because if we see this particular area, there has been a break of structure at this point, right? That has been a break of structure. And if I zoom out, you will see that this market has actually been having higher highs and higher lows, right? It has been having higher highs, right? And it has been breaking structure to the upside. So market was initially bearish because it broke this structure here. It broke this one again here, broke this one again here, right? Moved up, but couldn't close up, broke it again here. Now, what happened after that last low? Market started going up, then it started breaking structures. If I zoom out, you see that market has been breaking structures, right? From here, you can see market broke here, right? It has been breaking all these internal structures as well. Then this is the external swing, which has been broken again here, right? So we can see that market has been bullish. Even this the latest market trend here, you see market has broken this area. Now this last low is yet to be broken. As you can see, market has actually swept it, and it looks like it's going back to the upside, right? So the first things first, we must identify the trend importantly, right? Now, this, from what I've shown you here, I basically use price action. I don't use moving averages. I don't use trend lines. I only use pure price action for this video, right? So, now, pro tip. Basically, we are basically swing trading. If the weekly chart is in a strong uptrend, we are only looking for longs on the daily charts, right? We are basically looking for longs on the daily charts. It's simple. If the weekly chart is moving sideways, that is, if it is consolidating, we will be careful about taking any kind of trade. In fact, we might probably want to sit it out a bit, right? So you don't want to be trading against the trend, because that is an easy way to lose your capital, right? Now let's move on to these setups. I know this is particularly interesting for a whole lot of people. So let's talk about these setups here. So for setups, now you know where the trend is going to, right? Probably you know where how the market is moving, right? Now you don't just buy or sell. No, you don't do those. We need to master a few things so that you don't chase every shiny object you see on the chart. First, pull back to support. That's the first one. That's the first thing or the first strategy we will talk about. So pull back to support. Let's use this current market trend here. Let me take this off. Okay. Let's use this current market trend. So from what we can see here, markets went up. Market broke this structure here, broke here, then went up. Right? That is, it rallied from this point. It rallied at first from this point. Market rallied, right? Now, but after it rallied, what happened? Markets came back. Let me look for this stuff here. Excuse me. I need to draw this thing as well. So we are looking for pullback and supports. That's what we are looking for. Right. So after market has rallied up to the upside, this is the pullback. And this is like this move here. This is the pullback. Right. And in that pullback, this is the support it is coming to breach. That is, it is coming to liquidate so that it can continue moving to the upside. Right? That's the particular support it's coming to breach. So this is a pullback. I'm not sure, I'm not certain that, but if this market breaks beyond or below this particular support, that is this support here, then we might start looking for sales. But for now, market is only making a pullback because we are still in a strong uptrend. Right? The previous move, in fact, has been a clear break of structure to the upside. Right? So that's the most important thing. So the key is that you don't buy the very first candle or the very first day of a pullback. You wait for a confirmation. Sometimes it could be a bullish candlestick pattern, or it could be a break of structure in the micro trend, that is in the hourly charts. So just something that says the sellers are done. Let me use this example. Right. Let me use this example here. Now, as we can see, that market has actually cleared this particular support. That is, it has liquidated that particular support. Let me draw it clearly. So the previous week liquidated that, actually took out this support level, right? Now this is the weekly time frame. If I switch to the daily time frame, you will see something. That is why I say don't trade the very first candle. Don't trade it. In many cases, I stay out. Right. So this is the first day, being Monday of the new week, just current week, because today is Friday. I'm making this video. Right. As you can see, market still came down a bit, but we are looking for what? The move up. Right. So as you can see here, this is a bullish engulfing pattern that has formed here. This particular candle here is a bullish engulfing pattern, right? Because why? It's actually closed with a full body above the previous bearish candle, right? So now this is showing us that the sellers are done in the market. The buyers are taking over. Right? Is that clear? Forget the next bearish candle that came in. No, it actually came to clear that particular support again to actually show us that yes, the buyers are back in the market. So another strategy again that what I use sometimes, not oftentimes, is the breakout and retest pattern strategy, right? That's the breakout and retest. Now, this was the breakout and retest. Let's try the for our charts. I think in the lower time frame, that is where this particular phenomenon usually happens more frequently, and you can find this particular kind of setups easily, right? Now, if you watch here, market actually, this is a breakout is basically a break of structure, right? Okay, so this is a clear break of structure, right? So market actually broke out, but what happened? It came back again to retest a level beneath. Right? So this actually shows that this is a strong trade to take, because if you see here, this market actually came back down to actually test the support down here. It's something we call QMR or QM, but it's not something I will talk about in this video. So market actually, I took this trade, but I already exited this my position. Right, so yeah, because I was looking out to enter another trade. So this is the breakout and retest pattern. Now, let's talk about another method you can use to enter your trades, and that is by using candlesticks. Right, candlesticks are very very important when we are swing trading. Now, I'll show you some kind of candlesticks that are very very important for this particular strategy we are trading. So firstly is the bullish engulfing, like the previous one I talked about. Right now, after that, after this particular, let's go back to that particular day. So let's use, for example, this is a clear bullish engulfing candle here. Like I said earlier, this is a strong direction that okay, this market is actually ripe for the buyers to step in. And again, it did not just engulf this candle, the same bullish engulfing broke this structure here, right? So it broke that particular structure. So that is one candlestick pattern that we can use. The second we will use is what we call the hammer, right? The hammer is actually a candlestick. The actually is actually a sorry. The hammer is actually a candlestick with a body, right, and a long shadow, right? So it actually means that that direction is exhausted. Right? So let me show you an example of that, of a hammer. Good. As you can see, this particular candle here, this particular candle, right? What happened? A small, a smaller body with a long wick, right? He rejected price. Right now, immediately he rejected price. What happened? Price started moving to the opposite direction. That is another candlestick we can use. Then the one I use the most is the morning star, and that is a three candle pattern, right? It's a 3 candle pattern, and I'll show you an example here. So this is it here. This is a morning star. It's what I use the most. I did not enter this trade on this day where the bullish engulfing happened. No, I waited for this bearish one to happen. Now, why did I wait for it to happen? If you see here, this is a support that is this particular bearish candlestick and the bullish candlestick. It's actually a support, right? Now, after that support, what happened to the support? We had a bearish candlestick that actually swept the liquidity off that support level. Right? It doesn't matter if the wick goes to any length. As far as it clears, it comes down below the body of this bearish pattern here, candle, we are good. Right? So this is the morning star. And this is what I use the most because it is one of the strongest candlestick patterns out there. Right, so immediately I see this rejection, I am automatically ready to start entering my trade. Right. Now let's talk about risk management. Now, everything I have said so far is worthless if you don't manage your risk. Truth is that you can be right probably around 70 to 80% of the time, but you will still be unprofitable or probably go broke, right? In many cases, that is, if your losers are probably 3 times the size of your winners, right? So risk management is not just a footnote, but it is the entire game. So rule number 1, the 1% rule. You should never risk more than 1% of your total trading capital on a single trade, right? You should never do that. Take, for instance, if you have a $50,000 account, right? Your maximum risk per trade should be $500. That is 1% of your 50,000. If you have a $5,000 account, your maximum risk per trade should be $50. It's that simple. So always risk just 1%. Now, after you risk your 1%, then we will move to the next level. So now when you risk this, when you actually apply this kind of risk management, it means that you will actually have 10 times opportunity before you lose your money. That's the fact, right? And at least if you get a 30% win ratio, you are good to go. Rule number 2, your stop loss is non-negotiable. Your stop loss is mostly not just a suggestion. No, it is an order that is placed the moment you enter the trade. You just cannot say, oh, I'll stop at this particular point. No, you just watch your trade go from 5% to 20% loss to 80% loss, and then you lose all your trading capital. Not good. Now, where do you place your stop loss? You should place it just below a logical support. Take for instance, if I'm going to take this trade, let's use this example. After I saw that this particular day this morning star pattern has formed and rejected this particular area, this is on a Wednesday, right? Then I'll move to the 4-hour charts, right? I'll move to the 4-hour charts. I'll consider where did it happen, right? So this is it here, Wednesday. Now, This is the last candle for Wednesday. Let me drag this stuff here. This bearish candle is the last candle of the day. I will place my entry at this point. I'm going long. I'll place my entry at the support before the last close. Then I'll place my stop loss just below the previous day low. That's it. Right? That's it, because the previous day low is just this particular area I drew this line. That's where I'll place it. Right? So you should always know where to place your stop loss. I wouldn't want to drag it down this level. No, I don't need to do that. I'll just leave it at the previous day close. That's enough in many cases, right? So that's that. Now, in many cases, your risk to reward in many cases I usually target at least 1 to 2 or 1 to 3. I don't go below 1 to 2. That's my rule, right? So I said I took out my profit already. This was where I took out my profits. I just targeted this particular area and it gave me a 2-2. That's almost three risk to reward. So this was just a simple trade I took early this week basically. Now, your profit target is usually at the next logical place, right? For me, I saw that this market might be initially in the weekly time frame, we saw that it was looking like a pullback, but we are not certain. We cannot be 100% certain, right? So we don't know if markets will continue rallying up or it will probably sink again below and break that structure. So I was just protecting my capital and just left it here, right? But you can choose to actually leave it that way and ride it out to the extreme swing points. That's your choice. That is this particular area, and it's good, right? It's good if you can ride it out. So that's basically how to swing trade. So if you've liked this video so far, I want you to consider liking the video, share, support, grow the channel, put on the bell notification, and I'll see you in the next one.